Welcome, curious deep divers. Ever feel like diving into the world of investments is like navigating a dense jungle full of jargon hitting traps?
It certainly can feel that way. And look, if you don't know your assets, you can't truly understand your potential risks or, the rewards. We're
Exactly.
here to lay that foundation, give you the knowledge you need for your financial future.
That's right. Today, our focus for this deep dive is MicroStrategy's perpetual strike preferred stock. The ticker symbol is STRK.
hmm
And this isn't your everyday common stock, folks.
No, it's a preferred stock, and believe me, it comes loaded with some, let's say, unique characteristics. Definitely needs a closer look.
Our mission today, it's crystal clear. We're here to help you, our listener, understand precisely what STRK is, how it functions within MicroStrategy's whole strategy.
Which is pretty unique in itself.
Right. And maybe most crucially, what a hypothetical $10,000 investment into this specific stock could realistically look like, say, over the next 5, maybe 10 years.
We're cutting through the noise, the jargon, giving you the core insights, delivering the essentials without getting bogged down.
Consider this your express lane, your shortcut to becoming really well-informed on STRK. We've gone through the official source material, that's the preliminary prospectus supplement, dated January 27, 2025.
Yeah, this isn't just talk. This is the official document, the bedrock.
And we're going to help you understand its nuances, give you that edge. So let's get into it. You can't see me, but you'll definitely feel the impact of this knowledge.
Yeah.
Okay, let's unpack this. Let's make it simple for a second. Imagine, like, you're at a candy store, right?
Okay, candy store.
And you've got a special kind of golden ticket. Not just any ticket, mind you. This is a preferred golden ticket. That's kind of what STRK is.
That's a good way to put it. And what's fascinating here is that this ticket, STRK, it's offered by a company called MicroStrategy. Now, MicroStrategy isn't just one thing. It's like a superhero with two secret identities.
Real identities. All right, lay it on us. What are these two sides?
Well, the first identity is, let's call it the brainy software builder. This is their core business, their foundation. They create these really smart computer programs like MicroStrategy 1.
The ones big companies use.
Exactly. Big companies, government agencies. They use this software to analyze tons of information. It helps them understand all their puzzle pieces, make sense of their data, make smarter decisions.
Like seeing the whole picture instead of just scattered Lego blocks.
Precisely. And they've even added generative AI stuff, making it easier for, non-tech people to use analytics. It's a solid software business.
Got it. So the tech powerhouse behind the scenes, important stuff. What's identity number 2, the one that gets all the headlines?
Identity number 2, the Bitcoin Baron. This is where MicroStrategy really stands out. They've adopted this really significant corporate strategy of buying and holding massive amounts of Bitcoin.
Yeah, I've heard about that. They see it as like digital gold.
That's the idea. A long-term asset, a hedge, a store of value. They're collecting this digital treasure, hoping it grows in value over time. And they fund these big Bitcoin buys, in part, by issuing securities, like this preferred stock, STRK.
Okay, so the STRK golden tickets are basically how MicroStrategy gets money to do more of what it does run the software business, but also, and maybe more importantly for the stock story, buy more Bitcoin.
You got it. That's the connection.
So if you get one of these golden tickets, one of these STRK shares, what do you actually get? What's the payoff?
Okay, this brings us to the treats first concept. This is fundamental to preferred stock. Holding STRK means you generally get certain treats. Those the dividends before the people holding the regular tickets, the Class A common stockholders, get their treats.
Like getting dessert first at the fancy restaurant analogy you used earlier?
Exactly like that. And the prospectus mentions a specific number, a stated liquidation preference of $100 per share of STRK.
Liquidation preference. What's that mean in simple terms?
It means if the company were to unfortunately liquidate, go out of business, you, the preferred stockholder, would theoretically stand in line to get back $100 per share, plus any dividends they still owe you.
Before the common stockholders get anything back?
Before the common stockholders get a dime from the remaining assets, yes.
You mean they get to the front of the line for the treats and potentially get their initial stake back first if things go south? Are you serious? That sounds like a pretty significant advantage.
It is a preferential position, absolutely. It's designed for stability, income priority. But like anything in finance,
There's always a but.
there's always a but. That preference comes with its own detailed rules, trade-offs, things you absolutely must understand, which leads us right into the inner workings of this golden ticket.
All right, here's where it gets really interesting, deep divers. Because this STRK, it isn't just a simple preferred stock. It's got some, let's say, powerful moves hidden inside, some intricate features.
And understanding these features is absolutely critical if you're thinking about that $10,000 investment. These details define the security, how it might perform, how it reacts to different market stuff.
It's like knowing the opponent's special moves before you step in the ring.
You could say that. It's about knowing the playbook. So
Yeah.
first up, cumulative dividends. This is a big one.
Cumulative,
Yeah.
meaning they add up.
Exactly. The company owes you those dividend treats at a specific annual rate. Let's just, for example, say it's set at 8.5% a year on that $100 value.
Okay, 8.5% annually.
The key is cumulative.
Yeah.
If MicroStrategy hits a rough patch and can't pay a dividend on time, it doesn't just vanish, it accumulates, it piles up.
Like an IOU they have to pay later.
A mandatory IOU. They must pay all those piled up unpaid dividends to you, the preferred holder, before they can even think about giving any dividends to the common stockholders.
Wow, that's a strong protection. And when are these usually paid?
Typically quarterly. End of March, June, September, December. Usually starting maybe March 31st, 2025 for this one. Paid in arrears, meaning after the quarter ends.
Got it. So a regular potential income stream with a safety net if they miss a payment. But how do they pay it? Is it always cold, hard cash?
And here's a crucial piece of flexibility for the company. They can choose how to pay declared dividends. It could be cash, or it could be shares of their Class A common stock.
Or mix of both.
Or a combination. This is really important for you, the investor, to grasp.
Okay, so if they pay in stock,
Yeah.
how does that work? Do they just hand over shares based on the current price?
Not quite. There's a specific mechanism. If they pay in stock, those shares are valued at 95% of the daily VWAP, the Class A common stock.
VWAP. Sounds like a wrestling move.
It stands for volume-weighted average price. Basically, it's a truer average price based on actual trading volume over a set period, usually like the 3 trading days right before the dividend payment date.
So 95% of that VWAP price, meaning you get the shares at a slight discount, like 5% off.
Exactly. A 5% discount on the common stock you receive is your dividend, which is nice, but it also might signal they're trying to hold on to their cash.
Right, conserving cash. Makes sense. But what if the stock price tanks? Is there a limit to how many shares they give out? You mentioned a floor price earlier.
Yes, a very important detail, the floor price. Let's imagine, hypothetically, an initial floor price is set at, say, $525 per share of Class A common stock. This acts as a safety valve.
How so?
Well, if the common stock price drops really low, calculating the dividend payment at 95% of the VWAP might mean they'd have to issue a huge number of shares. The floor price prevents that extreme dilution.
I see.
If the number of shares needed, calculated at 95% VWAP, hits that $525 floor limit, meaning giving you more shares would imply a price below $525, then they can't just give you fewer shares than the dividend is worth. Any shortfall, any part of the dividend not covered by shares because of the floor price must be paid to you in cash.
As long as they're legally able to pay cash, right?
Yeah. As long as they're legally able, yes. So it protects the company from crazy dilution, but it also ensures you get some cash back if the common stock is really struggling.
Okay, that's a complex but clever mechanism. So payment flexibility, potential stock dividends, but a cash backstop with the floor price. Where does the cash come from for these dividends, especially when they're buying so much Bitcoin?
Good question. The prospectus itself is quite clear on this. MicroStrategy expects to fund cash dividends primarily through, wait for it, additional capital raising activities.
Meaning not necessarily profits from the software business?
Not necessarily, or maybe not entirely. It means they likely anticipate selling more stock, perhaps their Class A common stock via at-the-market offerings, or issuing other debt or equity to get the cash needed to pay dividends on this preferred stock.
Wow, so they might sell common stock to pay dividends on preferred stock. That's quite the financial engine.
It's a mechanism investors need to understand, absolutely. It links the dividend security back to the company's ability to continuously access capital markets.
Okay. Now, what about swapping these preferred tickets? Can I trade my STRK for the regular Class A common stock, like convert it?
You can. That brings us to conversion rights, the ticket swap. As a holder of STRK, you do have the right, under certain conditions, to convert your preferred shares into Class A common shares.
What kind of conditions and how many shares do I get?
There's an initial conversion rate set. Again, hypothetically, let's say it's 0.0667 shares of Class A common stock for each share of STRK you hold. That would imply an initial conversion price of around $1,500 per common share.
Meaning if the common stock trades above $1,500, converting starts to look pretty good.
That's the incentive, yes. The conversion becomes in the money. Now, the conditions for when you can convert, usually any business day during the last month of a calendar quarter, or if the company calls your shares for redemption, or if there's a big event like a fundamental change, like merger, acquisition, or a classic common stock change event.
Okay, so specific windows or events trigger the conversion right. That gives you a path to maybe capture more upside if the common stock, fueled by Bitcoin perhaps, really takes off.
It does provide that link to the common stock's potential growth. However, there's a key feature missing here that you sometimes see in convertibles.
Oh, what's that?
STRK explicitly does not have a make-whole provision.
Make whole, meaning?
Meaning the conversion rate doesn't automatically adjust to compensate you if certain events happen that might reduce the value of your conversion right. For example, if MicroStrategy bought back a ton of its own common stock for cash, or if the stock got delisted somehow.
Wait, the conversion terms wouldn't change to protect my option value in those cases? That's a low blow. You'd think they'd cover you if the game changes under your feet.
It's a specific design choice. It means the risk associated with events that could diminish the value of that conversion option rests more heavily on you, the preferred stockholder. It emphasizes the direct exposure over built-in protection for certain scenarios.
Okay, noted. A potential vulnerability there. What about the company buying the shares back? Can they force me to sell?
Yes, under certain circumstances. This is redemption and repurchase. The company can buy back. They have an optional redemption right. If the total amount of STRK outstanding falls below 25% of what they originally issued.
So if most of it has already been converted or bought back?
Right. Then they can choose to redeem all the remaining STRK shares for cash.
At what price?
At the liquidation preference at $100 per share, plus any accumulated and unpaid dividends.
So they can basically cap my upside if things are going well, but the amount outstanding gets low.
That's one implication, yes. They also have a tax redemption right. If some tax law change happens that negatively impacts them, say regarding dividend deductibility, they might be able to redeem all the STRK.
For the same price.
For that, the price is the greater of the $100 liquidation preference or the average trading price of STRK over the 5 days before the notice, plus, again, any accumulated dividends.
Okay, slightly different calculation there. Any other buyback scenarios?
There's also a protection for you. If a fundamental change happens, like the company gets acquired or sells off most of its assets, you, the preferred stockholder, get a fundamental change repurchase right.
Meaning I can force them to buy my shares back.
Exactly. You can require them to repurchase your STRK for cash, again at the $100 liquidation preference, plus accumulated dividends. It gives you an exit route if the company fundamentally changes structure.
Got it. Redemption rights for them, a repurchase right for me in specific situations. Now, what about having a say? Do STRK holders get to vote? Step into the ring and influence company decisions?
Generally, no. STRK has no voting rights on typical company matters.
Seriously? No vote at all?
Almost none. There's a very narrow, very specific exception. It only kicks in if the company fails to pay the full amount of cumulative dividends for a significant period.
How significant?
Like 4 or more consecutive regular dividend payment dates missed, or 8 or more consecutive regular dividend payment dates missed. If things get that bad.
Then what?
Then, and only then, do the preferred stockholders collectively get the right to elect 1 or 2 directors, called preferred stock directors, to the company's board.
So it's like you only get to vote for the team captain if the team hasn't just lost, but has been losing consistently for a really, really long time. You can't see me if I'm not voting, and with STRK, it sounds like I won't be voting much.
That's a fair analogy. It's not an active governance role. It's a backstop against severe, prolonged financial distress and failure to pay dividends.
Okay, makes sense. Last piece of the puzzle then. Where does STRK stand in line if things go really wrong, like bankruptcy? You mentioned liquidation preference earlier.
Right. Ranking in the line for assets. This is crucial. STRK ranks senior to MicroStrategy's Class A and Class B common stock.
So ahead of the regular shareholders.
Yes. For receiving dividends and assets in liquidation, you, the preferred stockholder, are ahead of the common stockholders. That's the preferred status in action.
Good spot to be, relatively speaking.
Relatively speaking, yes. However, and this is a massive however, for risk assessment. STRK ranks junior to all of the company's existing and future debt.
Junior to debt, meaning?
Meaning all the company's lenders, bondholders, anyone they owe money to in the form of debt, gets paid back in full before you, the STRK holder, see a single penny in a liquidation.
Okay. How much debt are we talking about?
As of the prospectus date, September 30, 2024, MicroStrategy had about, get ready for this, $7.274 billion in consolidated debt outstanding.
Whoa, a $7.2 billion with a B.
With a B. And all of that debt ranks senior to STRK, every single dollar.
So let me get this straight. If the company goes under, they have to pay back over $7 billion in debt before the STRK preferred stockholders, who are theoretically owed $100 per share plus dividends, get anything.
That is the hierarchy. You're ahead of common stock, yes, but you're behind a very, very substantial amount of debt.
That puts the preference in perspective. It's preferred relative to common, but definitely not preferred relative to the lenders.
Precisely. And one more layer. The company can issue more preferred stock in the future, and that new preferred stock could rank equally with STRK, or potentially even senior to STRK.
Without current STRK holders getting a say.
Without current holders' consent, yes, according to the terms outlined. So your position in the line isn't necessarily fixed. It could be diluted or even pushed back by future actions.
Man, that's a lot of complexity baked into this golden ticket. Senior to common, junior to billions in debt, and potentially junior to future issues. Understanding that ranking is critical.
Absolutely essential for assessing the true risk profile. And all these features, all these mechanics, they naturally lead us to the next big question. What could possibly go wrong? What's the potential for a smack down on your investment?
All right, let's face the hard truths now. We've seen the potential benefits, the special moves. Now, let's talk about the obstacle course. What can make this golden ticket, well, less golden, or even downright tarnished?
No investment is risk-free, and STRK certainly isn't an exception. There are significant factors here. The biggest, the one that overshadows almost everything else, is the Bitcoin volatility roller coaster.
Yeah, we touched on that. It's tied heavily to Bitcoin.
Heavily is an understatement. The company's value, its stock price, its perceived ability to service debt, even its ability to pay cash dividends on STRK, it's all profoundly influenced by Bitcoin's price swings. And those swings can be wild.
You mentioned the range before, like $40,000 to over $100,000 in just a year.
Exactly. In the 12 months before the prospectus, it ranged from below 40K to above 105K on Coinbase. That's extreme volatility. And remember, Bitcoin itself doesn't pay interest or dividends.
Its entire return depends on the price going up. Pure appreciation.
Pure appreciation. And that comes with unique risks. Bitcoin is still relatively new, right? Regulatory uncertainty is huge. Different countries, different rules, potential crackdowns.
Plus the tech risks. Hacks, exchange failures.
Security failures on exchanges, fraud potential, yes. Then there's MicroStrategy's concentration risk. They hold so much Bitcoin. A big price drop hits them hard. Plus, new digital assets could emerge. Bitcoin could face liquidity issues if they need to sell large amounts quickly. It's a complex landscape.
It really is.
You have to understand that fundamental element of risk with digital assets. Know your role. If the market turns against Bitcoin, if that value isn't there, it changes the entire game for MicroStrategy and by extension for STRK.
So a Bitcoin downturn is the #1 threat. What else is lurking?
Next up, dilution, dilution, dilution.
Yeah.
We talked about how dividends can be paid in stock.
Right, which increases the number of shares outstanding.
Precisely. If MicroStrategy pays dividends in Class A, common stock frequently, or if they keep issuing more stock, common or preferred, to raise capital for more Bitcoin buys, which the prospectus explicitly says they can do, then your stake gets diluted.
Meaning my slice of the pie shrinks if I eventually convert my STRK.
Your potential ownership percentage shrinks, yes. And the value per share, whether preferred or common, could also face downward pressure just from the increased supply of shares flooding the market.
And you mentioned short sellers earlier. How does STRK affect that?
The existence of a convertible like STRK often encourages sophisticated investors to do convertible arbitrage. They might buy STRK and simultaneously short sell the Class A common stock.
Betting the common stock price will fall relative to the preferred.
Essentially, yes, playing the pricing difference. But if lots of people are shorting the common stock because of STRK, that activity itself can put downward pressure on the common stock price. It's a feedback loop.
So the structure itself might weigh on the common stock price. That's another layer of complexity. What about just selling STRK if I want out?
That leads to liquidity and market dynamics. Just because STRK has a quoted price doesn't mean you can easily sell a large amount at that price whenever you want.
The market might be thin.
Exactly. The liquidity, how easily you can buy or sell without affecting the price, depends on many things. The common stocks volatility, interest rates, the company's financials, the overall demand for securities like this.
So if I want to sell my ticket, there might not be many buyers ready to play, or they might lowball me. That's a tough break.
It's a real risk, especially with more complex securities. And it ties back to that arbitrage point. If regulations change or market conditions make it hard or expensive to short sell the common stock,
The arbitrage players might bail.
they might unwind their positions. They were buying STRK and shorting common. If they stop shorting, they might also sell their STRK. That could suddenly remove a major source of demand for STRK, potentially tanking its price and drying up liquidity.
Wow. So the actions of other sophisticated investors could directly impact my ability to sell my STRK shares at a decent price.
It's a dynamic you need to be aware of. Now, beyond Bitcoin and market mechanics, what about MicroStrategy itself? The actual business.
Right, the brainy software builder part. Does that have risks?
Absolutely. Company-specific risks beyond Bitcoin. Their software business relies heavily on one platform, MicroStrategy One. The shift to cloud subscriptions, while maybe good long-term, can mess with revenue timing short-term and maybe increase customer churn.
And the AI stuff they're adding.
Integrating AI is promising, but it carries risks reputational damage if the AI messes up. Legal liabilities, potential software bugs, or security holes. Standard tech company risks, but still important.
What about bigger picture stuff, things outside their direct control?
Sure. Operational and external factors. Things like geopolitical issues, natural disasters, economic downturns, they can disrupt any business. Government contracts have their own risks. Retaining key people is huge.
Especially Michael Saylor, right? Given his control.
Exactly. His influence is massive due to his majority control of the Class B voting stock. Losing key personnel is a risk. Changes in privacy laws could impact them. And cybersecurity attacks are a constant threat for any company holding sensitive data or running critical systems.
So the software business needs to keep humming along too. It's not just about Bitcoin.
It's not just Bitcoin, though Bitcoin strategy heavily influences their financial condition and ability to service that huge debt load. Their equity market cap is way higher than traditional valuation metrics would suggest, largely because of Bitcoin, which itself can lead to higher stock volatility.
Okay, one last area of risk, you mentioned taxes. That sounded potentially nasty.
Yes, tax considerations. This could be tricky. There's something called deemed distributions.
Deemed. Meaning
Meaning the IRS might consider certain events related to your STRK as taxable income to you, even if you never received any actual cash. Things like adjustments or non-adjustments to the conversion rate or even dividends that accumulated but weren't paid out yet.
Are you serious? I could owe taxes on money I haven't even seen. That could really bite into returns unexpectedly.
It's a complex area and definitely something to discuss with a tax professional. The prospectus also mentions the risk of STRK being classified as fast-pay stock.
Fast pay, what's that?
It's a specific adverse tax classification. MicroStrategy states they do not believe STRK is fast-pay stock, but they acknowledge the risk, especially if they issue more STRK shares later at a premium.
And if future shares were deemed fast pay, could that affect my shares, the ones I bought earlier?
Potentially, yes, because they might all trade fungibly under the same ticker symbol. You might have the burden of proving to the IRS that your specific shares aren't the problematic ones. It could get complicated.
Okay, so Bitcoin risk, dilution risk, liquidity risk, business risk, control risk, and tax risk. That's quite a minefield to navigate.
It highlights why thorough due diligence is so critical. You need to know all the potential traps before you step into the arena. Knowledge is power.
All right, deep divers, let's put it all together. The moment of truth. It's time to put on our prognostication hats. If you were to put $10,000 into STRK today, what's the scorecard looking like? Say 5 years from now, 10 years down the line. This is where the rubber meets the road.
This is where we apply all that knowledge. And look, the outlook for that $10,000 isn't one single path. It's really a range, a spectrum of possibilities. It's shaped by everything we've discussed, the nature of STRK, the company's strategy, the Bitcoin factor.
It requires some critical thinking, weighing the potential wins against the potential, well, the potential smackdown.
Exactly. So let's start with the sunny side. What does the optimistic path look like for that $10,000? Where's the potential upside?
Yeah, give us the dream scenario first.
Okay, the optimistic view hinges on a few things working out well. First, consistent dividend income. If MicroStrategy declares and consistently pays those cumulative dividends.
That hypothetical 8.5%.
Right, using that as an example. On $10,000, that's $850 a year. If paid in cash, that's a nice income stream flowing back to you. If they pay in stock, remember that 5% discount.
Yeah, you get more shares.
Right, those shares add to your holdings like automatic reinvestment, compounding your position over time. That's powerful, especially if the underlying common stock is also going up.
So, steady treats, either cash or more shares. Solid foundation. What's the big driver, though?
The big catalyst, the potential home run, is Bitcoin appreciation fueling common stock value. This is the core bet. If MicroStrategy's Bitcoin strategy pays off big time, if Bitcoin's value climbs significantly over the next 5-10 years.
Then MicroStrategy's own stock price should follow.
Very likely, yes. Their massive Bitcoin holdings would drive up their balance sheet value, boost investor confidence, and likely push the Class A common stock price higher.
And that makes the conversion feature of STRK really valuable.
Precisely. Remember that hypothetical $1,500 conversion price. If Class A common stock zooms up to, say, $3,000, $4,000, or even higher, your right to convert your $100 STRK share into common stock suddenly becomes incredibly valuable.
Your $100 preferred share could suddenly be worth $200, $300, or more based on the conversion value alone.
That's the potential leverage. Can you smell what the rock is cooking? That's the aroma of potential growth if that core Bitcoin strategy truly delivers over the long haul.
Okay, so dividend income plus the potential for major capital gains through the conversion option if Bitcoin succeeds. Is there any other upside potential?
Well, there's also potential capital appreciation of the preferred stock itself. Even if you don't convert, the market price of your STRK shares could rise.
Why would that happen?
Strong company performance overall. Maybe the software business does exceptionally well and Bitcoin performs. Also, the general interest rate environment matters. If overall interest rates fall, preferred stocks with fixed-rate dividends tend to become more attractive relative to bonds, potentially pushing their price up.
And just general demand for this kind of hybrid security.
Exactly. Demand for preferreds that offer both income and that unique exposure, that call option really, on a volatile asset like Bitcoin could also drive the price of STRK higher in the market.
That's the optimistic path. Steady dividends, massive upside potential via conversion linked to Bitcoin, and maybe some price appreciation of the STRK itself. Sounds great. But we have to be real. What's the flip side? What's the cautious path?
The cautious path starts with the inverse of the biggest upside driver. Bitcoin crash impact. This is the #1 risk materializing. If Bitcoin experiences a significant, sustained drop in price,
That would hammer MicroStrategy's common stock price.
directly and significantly, which, in turn, makes your conversion option on STRK much less attractive, potentially even worthless if the common stock falls below your conversion price.
So, if Bitcoin takes a dive, your golden ticket might feel more like a participation trophy. Are you serious? That conversion upside just evaporates.
It could, yes. And a major Bitcoin downturn could also strain MicroStrategy's finances, making it harder for them to pay cash dividends, which leads directly to the next cautious point.
Persistent dilution. If they're forced to pay dividends in stock more often because cash is tight.
Or if they keep issuing lots more equity, common or preferred, to fund operations or buy even more Bitcoin, perhaps at lower prices, your initial $10,000 investment gets diluted. Your potential percentage ownership shrinks. The value per share might stagnate or fall.
Especially if the common stock price isn't rising enough to offset all those new shares being issued.
Exactly. Dilution can be a slow erosion of value if growth doesn't keep pace. Then there's the company redemption risk we discussed.
Right. They can buy back the STRK if the amount outstanding gets low enough.
Correct. They redeem it at $100 plus accumulated dividends. This caps your upside on the preferred stock itself. If the common stock then takes off after your STRK is redeemed, you've missed out on that ride.
So they can take your ticket back just when it might be getting really good, forcing you to reinvest elsewhere. That limits the home run potential of holding STRK long term.
It does limit the upside from the preferred share itself, pushing you towards relying more on the conversion value before redemption happens. And don't forget the overall business performance.
The software side still matters.
It absolutely matters. Even if Bitcoin does okay, major problems in their core software business, falling revenue, losing key clients, tech issues could hurt their overall financial health, impact their ability to handle debt, and maybe even affect dividend payments.
And the external stuff. The things they don't control.
Regulatory and tax headwinds, a sudden crackdown on crypto, new adverse regulations, or an unexpected negative tax ruling like that fast-paced stock issue, these could all hit the stock or your returns hard.
Yeah, the government changing the rules mid-game, always a risk.
Especially in newer asset classes. And finally, back to liquidity constraints. In a downturn, or if those arbitrage traders flee, you might find it difficult to sell your $10,000 worth of STRK quickly or at a price you feel is fair. You could be stuck holding it.
Man, optimistic path sounds amazing. Cautious path sounds, well, pretty rough. It really highlights the Bitcoin dependency and the structural complexities.
It does. So boiling it all down for your $10,000 over the next 5 to 10 years, its performance is largely going to be a function of a few key things.
Lay them out for us, the main drivers.
1, the long-term trajectory of Bitcoin prices. That's paramount. 2, MicroStrategy's execution. Can they manage the Bitcoin strategy effectively and keep the software business strong? 3, their ability to handle that significant debt load, especially if interest rates rise or Bitcoin falls. And 4, the broader economy and interest rate environment impacting both Bitcoin sentiment and the attractiveness of preferred stocks generally.
Bitcoin, execution, debt, macro. Got it. This has been a true deep dive, folks. You've just navigated the intricate world of MicroStrategy's STRK, armed with insights straight from the source, the prospectus, and our breakdown here.
The real power now is what you do with this knowledge. Understanding the layers, the features, the dividends, the conversion, the ranking, and especially understanding those risks we laid out.
Because that is how you become truly well-informed. That's how you make the best decisions for your money, your portfolio. You can't see the risks if you don't look for them.
Know your assets, know your risks. Consider how this deep dive shows that even something that sounds maybe a bit safer, like preferred stock, can have incredible complexity, especially when it's bolted onto a volatile rocket like Bitcoin.
So you got to ask yourself, are you prepared for that kind of rumble, that potential volatility, or are you looking for a more laid-back ride?
Because understanding all these angles, that's how you decide if an investment fits your goals, your risk tolerance. It doesn't matter what the prospectus says on page 50 if you haven't grasped the implications on page 5. It matters what you take from it, and that's the bottom line.
Use this framework. Apply this kind of deep dive thinking to other investments you look at. Be informed. Be prepared. Never give up on understanding where your money is going. Thanks for joining us on this deep dive.